So we're right in the thick of holiday season right now. You know, when families get together, and things can sometimes get a bit heated around the festive dinner table. All part of that holiday charm. One place getting into that festive spirit, so to speak, is the Federal Reserve. It cut interest rates this month, but it was far from a unanimous decision. Fed Chair Jay Powell downplayed the divisions around the table.
Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we made a decision today. We had, 9 out of 12 supported it. So fairly broad support.
But it's clear the US central bank is divided over what's the biggest potential trouble spot for the US economy, the labor market or inflation, and whether cutting rates is a good idea or a bad one. One person who's clear about what needs to be done is President Trump.
Again, I'm looking for somebody that will be honest with interest rates. So I just want honesty. Our rate should be much lower. Our rate should be the lowest rates in the world.
He wants interest rates floored and says support for cutting rates is a requirement for whoever he appoints to replace Powell as chair next year. It's setting the stage for a more fractious Fed, with big implications for the cost of everything, from your mortgage to your car loan, in the US and overseas. So let's get into it all. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, the divided Fed. So to get into all of this, I'm delighted to be joined by Ann Saphir. She's our Fed and economics reporter in San Francisco. Hey, Ann, welcome to the show. Well,
Hi.
Welcome back to the show, I should say.
Thanks for having me.
So, Ann, I wanted to get into first what we learned from the most recent Fed rate decision. They cut rates in December. What did we learn about how they arrived at that decision?
Well, it was definitely not an easy decision, and it was a close call. There were voices around the table who wanted that rate cut because they're worried about the labor market weakening. And there were a number of voices around the table beyond the dissents that we saw in the actual vote that were arguing for leaving rates where they are because inflation is still a problem.
Let's get into the economics of it all. What is the reason for that division? Why is there this split from an economic perspective?
Well, I mean, I think that the data are not that clear. We're at a moment where we have inflation has been running higher than the 2% goal for quite a while. It's closer to 3%, and it's expected to rise a little bit more because of the tariffs pushing up on goods prices. At the same time, the labor market is definitely softening. We're seeing more companies announce layoffs, but we're also just seeing companies not really want to hire very many workers. When the Fed looks at that, it sees this tension between the job mandate, which would mean lowering the interest rate, perhaps, or trying to push down on inflation to get it back to 2%, which would mean leaving rates where they are for longer. You only have one tool and you have these two problems, and so they have to pick.
Because the Fed's got like two goals, right? It has to maintain price stability and it also has to get, maximum employment. And right now the economy, it's in a funny position, isn't it? Where inflation is still rising, but the jobs market looks weak. So those two goals are sort of in tension.
That's right. And it's not that often where they actually are in tension because, if the labor market is softening, you would also, most of the time, you also experience inflation also softening because you've got less demand. And when there's less demand, there's less of a push up on prices. But where it is now, we have upward pressure both on the unemployment rate as well as on inflation. Everyone thinks inflation is too high. Everyone sees downside risks to employment. Everyone thinks that the labor market could get weaker from here and is in fact weakening. But what they don't agree on is which is the bigger risk. And that's what really the argument around the table was.
And these interest rate cuts that we've seen, I mean, the market gets so excited about when the Fed changes rates. A quarter percentage point, it sounds like a nothing burger. Like, why does it matter?
Well, I mean, in a way, you're right. It is a nothing burger. It's just a 0.25%. It's not going to do anything dramatic to where the economy is going in the moment. But part of what it is messaging, and part of what it is the accumulation of the rate cuts that have come before. So this last 0.25 percentage point was the last of 3 this year, and then there was another full percentage point of rate cuts they made last year. So altogether, that's nearly 2 percentage points of rate cuts, and that really does make a big difference. I think the other reason that a 0.25 point rate cut makes a difference is it's what is going to happen going forward. Is the message about what's going to happen next year. Are we going to continue to see more rate cuts, or is this about it? And that message that this might be about it is really what the Fed is trying to get across to markets, to kind of say, here's where you should kind of count on interest rates being, and this is where you can make your business plans. This is where you can make your spending plans and your borrowing plans, and that will move the economy hopefully in the direction that they are intending for it to go.
So kind of putting sort of guardrails around it, sort of steering the economy for next year.
Yes, exactly. Next year and potentially even beyond that. And it's true, it takes a while for the interest rates to actually get into the economy and do their work. Mm-hmm. But a lot of that happens in the financial markets right off the bat. All of the rate cuts expected for next year are sort of priced into markets now, which allows then the economy to function almost as if those rate cuts were a sure thing, which of course they're not. And all that could change as the economy changes.
Okay, quiz time. The Federal Reserve was founded by Congress in 1913, but it wasn't the first time Americans experimented with central banking. The first Bank of the United States, yes, that's its name, was established in 1791, but saw its charter expire in 1811. Now that's pretty old, but it's not the oldest central bank in the world. So which country is recognised as having established the first modern central bank? Is it A, Sweden, B, the UK, or C, Curacao? Bonus points if you can guess when that bank was founded. And we'll have the answer for you at the end of the show. Up next, we take a deeper look at the political dynamics shaping the Fed. And just to back up, can you explain how exactly does the Fed make its rate decisions? Like, who makes the call? Like, who are these people, and how do they do it?
Well, I mean, that's a really good question, because the Fed is kind of a unique beast among all of the central banks in the world. It has a board in Washington with 7 members headed by the chair, and then there's 2 vice chair. And then it has a network of 12 regional banks, each of which has a president, and each of which sends its president to Washington 8 times a year for these meetings where they discuss where the economy is and where rates need to be. So there are 19 policymakers sitting around a giant table. They meet for 2 days. And they spend a day discussing the economy, and they spend the next day discussing where rates should be. Of course, they don't come into that blind. Right. They have all had extensive discussions with the chair. By that time, the chair has a very good idea of where everyone stands and where he might need to guide the conversation so that he gets as many people on board with him in a plausible direction as he can.
And then not everyone gets to vote, right? There's a separate committee then, right, who actually makes the call on, actually votes on where rates go.
That's right. So at any given time, well, all of these 7 Washington-based members of the board vote, mm-hmm. And then 5 of the regional Fed bank presidents vote. One of them is a New York Fed president. He always votes.
Right.
And then the other 4 bank presidents rotate in And depending on which bank you are, it's every 3 years or every 2 years.
And the role of the chair is key, isn't it, in terms of sort of building consensus? That seems to be the model of how it's done. The chair sort of reads the room and frames the conversation.
Right. And I think the chair also has his own view. I don't think that we can discount that. If the view is fairly strong, we'll try to bring people along to it. I think that the interesting thing about what we're seeing today is most of the time you hear Fed policymakers say, it doesn't matter who has the vote. We all discuss the economy, we all discuss rates. And then at the very end of the meeting, the last 1 minute is the roll call, and they vote, and that's it, and then they adjourn. I think what we're seeing lately is a lot more emphasis on the actual people who are voting, and almost similar to what you might see in Congress, where you're actually counting votes. Do I have enough votes to get me here or there?
This time around, this December, the Fed obviously cut rates. 2 didn't want to cut. 1 wanted, Stephen Miran wanted a deeper cut, a 50 basis point cut. But beyond that, in this particular meeting, we also had what's called the dot plot, right? So it's the Fed's projections for next year. It's projections for, where its interest rate will be, economic growth, etc. Talk to us about that, because that also showed perhaps that the dissent was wider than just the actual vote on the rate.
Yes. So the dot plot is a chance for every Fed policymaker, unnamed, to lay out where they think the economy is going, where unemployment is going to go a certain way, the economy will go a certain way. And in order to get there, here's where I think rates will need to be. Mm-hmm. And so they do represent that in that dot plot. And this last time, there were 6 dots, so 6 translating to 6 policymakers who indicated that they didn't think that this rate cut should happen. And then there was, as you said, there was also the one policymaker who wanted a much bigger, a half-point rate cut.
So is this unusual, this level of dissent?
So the number of actual dissents is not actually that unusual. It is a bit unusual to have dissents in both directions, right? But we have seen that before, and we've also seen many more dissents back in the Volcker days. There were 4 dissents and 5 dissents.
That's Paul Volcker, who went hard against inflation, ramped up interest rates successively to clamp down on inflation, right?
Exactly, and there was a lot of pushback against that. There was a lot of political blowback as well back then, and we did not have a dot plot back then, so we don't know what that would have shown. Yeah. But as long as we have had this dot plot, this is the first time that we've seen such a large group indicate that they were not actually comfortable with the rate cut that was taken. That doesn't necessarily translate to an actual dissent. In other words, if you are a voter, you have a choice to dissent, which is a very, dramatic and strong showing of opposition, or you can kind of say, well, my argument has been made by these people at the table. I am anyway going to cast my vote with the chair because I don't want our decision to be seen as so fraught that people really can't bank on it.
Mm-hmm. I mean, we see in other central banks, I'm thinking particularly perhaps about the Bank of England, you do often see close votes, quite a lot actually, but it's not that typical for the Fed.
That is true.
That in itself is something that has market's attention.
Yes, absolutely. And I think that you can look at it in a couple of different ways. I mean, on the one hand, it's very natural that you would have people divided because the economy is kind of in a difficult juncture. At the same time, you're right, when you're not used to having a divided vote, the way, as you said, the Bank of England often has very close votes, that is a little bit unsettling for markets.
It kind of injects a degree of uncertainty that the market just doesn't like. Market doesn't like uncertainty.
That's for sure. Although there are certain traders who thrive on uncertainty.
Well, this is true.
That's how they do their trading.
There's always traders that thrive on something. If money and finance is your thing, we've got you covered. Our new sister pod, Reuters Morning Bid, is your go-to market briefing 7 days a week. All you need to do is go to the Reuters app or your favourite podcast player. You can also ask for your smart speaker for Reuters Morning Bid to get that market edge. And if you'd rather watch along, we've got a video version for you too. In the next part of the show, I ask Ann how President Trump has changed the White House's relationship with America's central bank. Ann, talk to us about the political dynamics that shape the way the Fed works. I mean, Trump is really at the heart of a lot of this tension right now.
That's true. And I think it's always true to more or less of an extent that the White House has a view about where rates should go that might not be what the Fed wants.
There's a kind of a natural tension anyway, regardless of who's in office in the White House. Right.
For sure. I think, generally the administration would like policy to be easier because it's easier on businesses. And the Fed is maybe looking at inflation and worried that easy policy could mess that up. I think what's extraordinary about this time is that Trump has been extremely vocal, not only this term, but in his first term, about how he feels about the Fed chair and other people on the Fed. I mean, the Fed policymakers will tell you that we don't pay attention to politics. We're just in the room. We just look at the data.
Yeah.
There is no question that the three Fed governors who were appointed by Trump, all supporting lower rates. It does break down, it appears, along political lines. But I guess that's a little bit different from saying that politics is driving what they're doing and that they're really looking over their shoulder at what Trump is telling them to do. Because in the end, what they decide about interest rates is going to affect the economy, and then it's going to blow back onto them. So they want to have cogent economic arguments backing up their rate views. And I think that, to a greater or lesser extent, they all try to do that as well.
I mean, it's economic orthodoxy, isn't it, that an independent central bank is a good thing? Can you explain the reasons for that? Like why an independent central bank is seen as crucial?
Sure. I mean, I guess the easiest way to explain that is if you think of a central bank as not being independent, if the politicians are deciding or telling the central bank what to do with rates, they're going to say, lower the rates, allow the economy to surge ahead. And we've seen that in a number of countries where the central bank is not independent, and that always ends up in tears and high inflation. And in the end, a weaker economy, because inflation is not kind to the labor market in the end, even if lower rates seem to be supportive of it at the beginning. Having an independent central bank, again, is seen as really important. And I think Fed policymakers see that as well. I mean, I used to never really think about who appointed who at the Fed, and certainly didn't particularly write it into my stories. But now I regularly do point out that such and such a governor was appointed by Trump or appointed by Biden, because it does seem to have some relevance, or at least some consistency with whether they're supporting easier or tighter policy. That's not to say that they're not independent, but I think that we're seeing the politics be more relevant now than we used to see. And I think there's a lot of concern that they will become more relevant still when a new Fed chair, for instance, is named. Trump's plan early next year is to name a new Fed chair. Fed Chair Powell will still be running the Fed for another number of months, and there will be someone who Trump has said he wants to take over and who will be out there giving his view and potentially swaying financial markets, even though he may not yet be in that position himself. So,
I mean, it's sort of unsurprising that politics is sort of featuring more kind of in the back of people's minds, or even in the front of people's minds, because there's been certain actions taken. You talked about how Trump will call out Powell, if he doesn't like what if he's unhappy with where interest rates are going. But there's also some of the actions that have been taken, like, for instance, the action against Fed Governor Lisa Cook, right? Talk us through some of those things that have happened this year that have been sort of extraordinary.
Trump's attempted firing of Lisa Cook, I think, has the biggest implications for Fed independence beyond anything that we've ever seen. So what Trump said, he was firing Lisa Cook for what he said were mortgage misrepresentations, potentially fraud. Mm-hmm. Lisa Cook has said those are not true. She's fighting it. The case is now before the Supreme Court, who will hear it in January. But really what's at issue here is the law says that the president cannot fire a Fed governor for anything but cause. And this is, again, to protect the Fed independence so that the president can't just pull people off the board that he doesn't agree with and stick people on there that he wants to do his policy, because then obviously the central bank would be entirely captured. And I think the general expectation is that the Supreme Court will not allow her to be removed. That would, I think, do a lot to assure markets and other observers that the Fed does remain independent from the president. But if the Supreme Court says, sure, you can take her off for this cause, which, there's been no proof. And again, she has denied it. If he can do that for her, he could do that for any of them. And even if he doesn't actually remove others, just the threat that he could at any time is going to have an effect on how the Fed conducts its business, and I think would really undermine any sense that the Fed can act independently of the administration.
2026 is around the corner, and Reuters Breaking Views columnists have been exploring what the year ahead will bring. Here's Liam Proud, an editor with Breaking Views, to tell us what their predictions are. Hey Liam, so what do you think 2026 has in store for us?
So we think, if the global economy is a party, it's 1 a.m. and everyone's looking around and wondering, do we need to pack up and go home? Or has this party got a few more hours of juice in it? And I think we broadly land on the positive side of that debate. So we're predicting the biggest M&A deal ever, for example. We think there's going to be a lot of deal making between companies. And it's kind of interesting, you haven't seen a deal that was as big as the 200 billion sort of mark that we hit in 1999, 2000. We think we're going to break that record next year. We're thinking a lot about AI. We think one thing that you will see more often is that people will interact with AI, ChatGPT, more through headphones, more through talking to it rather than typing into a text box. I think that's going to be big. And also on the AI theme, we think it's going to take people's jobs, unfortunately, particularly people who have just graduated from university, those entry-level jobs. And the way we turn that into a prediction is to say that a lot of teenagers will start wondering, do I actually want to go to university if there isn't going to be that entry-level graduate job for me on the other side?
Look forward to reading it all. Thanks a million, Liam.
Thank you.
Find those predictions and more published this week on breakingviews.com and Reuters.com. In the final part of the show, we look at what a more partisan Fed might mean for Americans. Talk to us about next year, Anne. It is going to be a pivotal year for the Fed. Are you ready for it? Are you gearing up for it? getting your energy level to the right level?
It's going to be a really interesting year. Trump has said he's going to announce his pick for Fed chair. We're going to have that Supreme Court hearing about Governor Lisa Cook, which is going to have huge implications for Fed independence. We're going to see the taps turned on for all of the data that has been missing. It's Powell's term ends in May. There's a question of whether he will stay on as governor. That would be extremely rare and hasn't happened for decades, that a Fed chair stuck around as a governor when there was another Fed chair coming in.
That would be a real sign, wouldn't it? If he made that decision, that would be a clear signal to markets that he was worried about the Fed becoming overtly political and captured. Yeah.
I think that's true. And I think it really depends very heavily on who is picked for Fed chair. He's been there quite a long time already, and I think he would be very happy to leave, but I think that he would feel compelled to stay if there was someone who he didn't feel could be trusted with the Fed. And that really would be extremely unusual.
I mean, in terms of the role of the next, like, of the Fed chair, it is just one vote, though, right? Like, all this speculation around who's going to be the next Fed chair, is it a little OTT in the sense that it is only one vote ultimately?
I mean, I guess you could say that, but it really is one vote that is more influential than any others, and that's partly because he's having these conversations with everybody and kind of listening, but also shaping his own view and shaping where the consensus is and bringing everybody along. It's very different than if people were just kind of calling in just for those 2 days of the meeting or whatever, and just like, oh, well, this is how I feel, sort of in a vacuum, because that's not how it's happening. They're trying to come to this together, and the chair really runs that process.
Trump has said that, whoever he nominates, he wants them to push for lower rates. So is he sort of already damning them in advance in the eyes of the market?
I mean, I think in a way that's true, although every person who is a candidate for this job has been very public about wanting rates to be lower. I think what's going to happen is once they get in that position, they will have to deal with being around the table and seeing all of these other Fed policymakers who have, all of their staff that they're working with and their views on where rates should be and where the economy is going, and all of their contacts in the communities with businesses and organizations telling them what's right and what's wrong with the economy. I think facing all of that, it would be very difficult for a chair to sort of push his view onto the rest of the committee if there weren't good reasons. I think a committee wants a leader, and if the chair is someone who is just seen as, Trump's guy who's just going to push for lower rates no matter what the data says, then it feels that the intellectual center of the Fed could very well shift to somebody else. I think it could have some very interesting internal shifts if you see a chair come in who is, already decided what he's going to do before he's seen the data.
It would mean more divisions, wouldn't it?
Oh, absolutely. And then in that case, I think the divisions actually might be something that markets would actually be happier about. If it was somebody who was seen as very political, I think markets would prefer to see a number of dissents. The Fed it is such an institution. I don't know how far you could get within the Fed in getting people to come to your view unless you really have the intellectual and the analytical backing for that view that could really convince others about it. If you go in with a shallow view, I think people will see it as a shallow view and move on, and because they do take their jobs very, very seriously.
I mean, but you could say that also of the Supreme Court, right? Which is also, it's a nominally independent institution, but it's definitely become a sort of a sphere for partisan battles in recent years, right? Like
that is true, and it's a really good comparison for the Fed because it is.
I mean, is it that is the difference that the Fed, the markets kind of put manners on the Fed in the sense that if the market perceives that it's not taking it and the battle against inflation seriously, that will cause ructions in the markets, and therefore there is that kind of
that is true. It can have some disciplining there for sure. The Fed has often said we don't cater to what the stock market does. We don't pay that much attention, but they actually do care very much because it affects the real economy. If financial markets start expecting a lot of inflation, that will affect the real economy, which really is what the Fed needs to take care of.
And for someone who's covering the Fed for a fair amount of time, how has the last few months changed things for you? Like as someone who covers it, the sort of the drama around it. It's kind of unprecedented, right?
Well, certainly in writing about the Fed, it never used to be the rule that the president's name would come up in every single bit of copy that I wrote, or the political situation. I mean, it is extremely relevant to not only what the Fed is doing, but how then what the Fed does reflects back onto the economy. And so there's the political presence in Fed stories is just much stronger than I've ever seen it. And also, it does feel that personalities matter quite a bit too. One thing that's very noticeable is that although there were a number of voters, for instance, who in the run-up to this month's decision indicated that they really would not want to cut rates, they in fact ended up voting to cut rates. And I feel like that part of that is tied to their personality maybe, or their sense that they need to kind of stand behind the Fed chair, kind of give him a little showing of support in the face of the attacks, I think we can call them, from the White House and from Trump himself. And then that's also been very interesting, just to see who actually feels that they need to cast a dissent and who feels that it's enough to kind of make their argument, but then go with the Fed in support of the institution, I guess.
Thank you so much for your time.
Well, thank you very much. I really appreciate it.
A big thank you to Anne for her time and insights. You can get all of our great economic coverage on Reuters.com and the Reuters app. Now for that quiz. I asked you which country established the world's first modern central bank. Was it A, Sweden, B, the United Kingdom, or C, Curacao? And the answer is A, Sweden. Its Sveriges Riksbank was founded in 1668. The Bank of England followed shortly after in 1694. And as for Curacao, the Caribbean island's central bank was founded in 1828. That makes it the oldest surviving central bank in the Americas. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Sebastian Sommer. Our executive producer is Leela de Kretzer. Remember, for all your daily market news, check out our new finance podcast, Reuters Morning Bid. You can catch it on the Reuters app or wherever you listen to your podcasts. And this is the last Econ World of 2025, so happy holidays, happy new year, and see you all back in 2026.